Well, if you look at the S&P 500 right now, it's actually still below where it was on an average price in January. We've had PE compression due to the rise of Fed funds and crossing over to a positive real rate, offsetting this very strong tax-fueled earnings growth. But as we look at the back half, I expect the dollar where it is now to actually impact second half estimates. We're seeing a tightening of global dollar liquidity that's affecting the non-U.S. markets. China's devaluation could continue and export deflation to the dollar-based economies. Trade's going to be a more volatile issue after the midterm in all scenarios than it was before. And then I am concerned that these financials relative to utilities have plunged, even though they're bouncing a little today, and that usually drags the 10-year yield down. It's good for growth stocks, but you would wonder how long the 10-year yield can stay up when the rest of the world's central banks have no appetite for tightening.
David, it sounds like maybe you agree with Barry a little bit there, because you say that while at the end of the last year you had a kind of glass half full, a little cautious, but half full at least, maybe you flipped and it's now half empty. Why?
Well, I certainly wouldn't think we're bearish, but I think cautious is a good way to talk about it. Barry hit some of the issues. The first one is the Fed. We think Jerome Powell has been a little bit more resolute than maybe some of his predecessors. Doesn't seem like he's backing off. Draghi certainly didn't sound like he was backing off in the face of volatility in Italy. So I think central banks are going to continue to pressure it. And I think trade and tariffs in this interim period we've had since first quarter earnings, as we wait for second quarter earnings, in that news lull, the market's going to get battered around by trade and tariff talk.
You think we've seen the highs for the year already, David?
I don't think we've seen the highs for the year, but we're not expecting a ton of upside. I think we might get back to where we ended. Maybe we'll crawl a little bit higher, but I would describe this market as sort of 2 steps forward, 1 step back. There's good underlying fundamental support, but there's still a lot of weight sitting on top of the market.
Market alert for you, Barry. The yield curve is now at a new low going back to 2007, 31 basis points between the 2- and 10-year notes at this point. You talked about that a little bit. Mind that a little more. I mean, is that what's the problem with the financials, and what is that telling us about the overall economy and potentially the market?
Certainly it affects financials, and also their cost of funds has gone up, but it's an overcapitalized industry and they're going to return a lot of capital, and that should provide some support for them. But what I've noticed is the staples healthcare utility trade, which benefits from the curve flattening and inverting, is back to the kind of lows that you had at the tech bubble in 2000 and in the very early 80s when we maxed out the 10-year yield. So to me, that's where there might be some out-of-favor value if you take a longer horizon and assume that the Fed will continue to tighten and eventually make a mistake, as they almost always do in their cycles.
Do either of you see the potential for a bear market on the horizon somewhere in 2019 or 2020, just in time for the election?
Is that question for me?
We certainly...
I would say...
Go ahead, David. Why don't you take it, and then Barry, I'll come back to you.
Yeah, I think we see the potential for a recession is if we look out to 2020 or 2021. Things have been so strong, I think naturally, as the Fed and other central banks begin to pull back, that's going to happen. The real question for investors is we know that the stock market is a discounting instrument. What is the window? What is the horizon when the stock market actually starts pricing that in? I don't know about a bear market, but we are much more worried about the stock market the later we get into 2019 and maybe early 2020.
Barry, quick final thought, very quick if you could.
Yeah, I don't disagree with Natixis there. I think 2020 is the earliest possible recession. I do think you could have a bear market by very late 19, early 2020 as the Fed proceeds in raising real rates, and there's some shock value to that.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.